Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to this week Through the Noise podcast. I'm your host, Heung, Senior Investment Strategist in our Chief Investment Office. With me today is Raymond Cheng, our CIO in North Asia. Welcome, Raymond. Let me greet you with a question on Europe first. So the market seems to be focusing on the potential ceasefire between Ukraine and Russia, and President Trump is pushing for talks between the parties. Can you elaborate on how this intervention has influenced market dynamics?
Absolutely, Ray. Trump's intervention has significantly reduced the geopolitical risk that has loomed over European assets since the conflict escalated. This decline in geopolitical risk premium has led to increased investor confidence, boosting both European equities and the euro currency. Additionally, a potential increase in European infrastructure and defense spending as a result of the potential ceasefire could further enhance European assets, reinforcing our case for a diversified investment portfolio. Now, in particular, the German coalition's plan to create a 500 billion euro dollars worth of infrastructure fund and boost defense spending further add to this positive sentiment. Now, if these initiatives materialize, we expect to see continued support for European equities. So far, the MSCI Europe Equity Index reached a record high in US dollar terms earlier this week, and the euro also rose to a 5-month high. The three of our four overweight equity sectors in Europe, namely financials, communication services, and healthcare, have led this year's rally, helping to offset the overall underweight stance of ours on Europe. Now, our global balance allocation is up 1.3% year to date, despite US equities flatlining. Even after the rally, European stocks remain inexpensive at around 14 times forward price to earnings versus US counterparts at over 21 times, while European earnings forecasts have also been ratcheting upwards.
Thank you, Raymond. So what are we expecting in terms of near-term drivers for European equities and also the euro?
Yeah, a couple of factors could drive the market in our view. Progress in Russia-Ukraine ceasefire talks, easing debt restrictions by European governments to increase spending, and the necessity for the German coalition to secure board support to implement these changes. In addition, negotiations between the EU and the US regarding tariffs will play a crucial role, along with any further rate cuts from the ECB.
Thanks. Let's switching gear to the US dollar. I think what we saw is the dollar index has broken below key support levels. What does it mean for risk asset in our view?
Yeah, a weak US dollar tends to bode well for risk assets. Now, as the dollar breaks lower, global financial conditions ease, making investments in risky assets more attractive. Now, this situation basically reinforces our case for a diversified portfolios. Now, as the dollar weakness typically correlates with rising values in risk assets. Now, we still think that the US dollar could face further downside. The broad dollar index, DXY, has plunged more than 3% this week to around 104, breaking below the 200-day moving average. The drop was primarily driven by a surge in the euro and the British pound. The downside momentum remains quite strong, but we think, technically speaking, the US dollar looks oversold for now, raising the chance of a near-term bounce. The DXY index has traded in the 100 to 110 range since year 2022. So another 4% potential downside could happen before it tests the long-term structural support. Now, we would sell the US dollar on rallies. Now, we position for further US dollar downside through a bearish US dollar Japanese yen idea. The Fed is likely to resume rate cuts going forward should flagging confidence hurt job creation, whereas the BOJ, the Bank of Japan, may likely hike rates as the Japanese wage growth accelerates amid labor shortages.
You mentioned the weakening of the dollar index is actually good for risk assets. So in light of the recent dip in the US equities, should investors consider this as an buying opportunity?
Yeah, we think so. The recent pullback in U.S. equities is a potential tactical buying opportunity here. Despite the decline, we think the overall outlook remains positive in the next 6 to 12 months. The decision to delay tariffs on automobile imports from Canada and Mexico indicates a more measured approach adopted by the Trump administration, which should support growth to a certain degree. And the S&P 500 index has technical support at the 200-day moving average of 57.29 in our view, with the next support at around 5,600. For investors looking for opportunities to add to U.S. exposures, we see such an opportunity for the S&P 500 below 5,800. The specific sectors we like within the US would include number one, technology software, which we believe would benefit from a faster AI adoption and faster development of AI applications. Number two, communication services, which is reasonably valued while enjoying structural demand for our online entertainment activities. Number three, major and regional US banks, which would enjoy industry deregulation tailwind. And four, US small caps that are leveraged to the domestic US economy and hence less direct exposure to tariff risks.
Let's stay in equity for a while. Do you mind giving us an update on Chinese equity or maybe and also an update on dollar CNH with the ongoing two sessions in China?
Sure. The two sessions have set ambitious growth targets, including a GDP growth target of around 5%. Now, while there are promising policy stimuli aimed at boosting domestic consumption and AI development, the challenges posed by potential US tariffs could not be underestimated. We expect the dollar CNH to likely trade sideways for now with a bullish bias towards 7.35 in 3 months' time. We remain neutral or core allocation towards China equities, but we do advocate a barbell approach towards two specific areas. Number one, the Hang Seng Technology Index, which we believe would be a direct beneficiary of more fiscal policy stimulus to come, as well as the faster AI adoption triggered by the DeepSeek emergence. As well as the second area being the Chinese non-financial high-dividend state-owned enterprises listed in Hong Kong with limited exposure to the U.S. exports and offer a defensive appeal in terms of a decent dividend yield.
Thank you, Raymond. That's all the time we have for this episode of Through the Noise. And thank you for all listening. And please stay tuned for our next episode. Bye.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.